Welcome back to Real Estate 101. Today we're going to talk a little bit about income tax planning and your mortgage, and I'm pleased to be joined once again by Tracey Brock of Dominion Lending Centers. Tracey, welcome back to the show.
Thank you, Joe.
All right, Tracey, so it's tax season.
Yes.
What do home buyers need to know?
Well, first-time home buyers, they need to know that in their income tax in the year that they purchased their home, they can actually get a rebate from the government, and both spouses can claim it, so you can both put it onto your income taxes. It usually works out to about $750 each, and as long as it doesn't exceed $5,000, they both can claim it. If you reference over to the website for the Government of Canada, which will be on the screen, there's a cute little video there and tells you all about it and how to make the claims and where you have to look for the lines and all that other stuff that goes along with making claims on your income tax.
All right, and what about for business for self people?
Well, business for self people have to really realize and understand that the government has made a lot of changes and they're becoming more and more strict with the insurers, so the Genworth, CMHCs, the Canada Guarantees of the world, on how income is claimed and stated. So there's two ways for business for self people. They can either do it with a stated income, or they can do it based on their line 150. And there are variances, like it's called grossing up, but you can do that. But they have to understand that what they claim is what they're going to be able to use to purchase their home.
All right, so when would you require default insurance, and is it the same for people that are self-employed and just regular people who have jobs?
Well, default insurance is up to a 20% down payment. It can go up to 35%, but most lenders assume the cost of that default insurance after 20, but it really just depends. So even if you have 20% in your business for self, a lot of lenders still use the default insurance, so you still have to follow the rules that CMHC, Genworth, and basically the Government of Canada is stipulating.
All right, so what are some of the qualifications, someone who is in business for self, what are some of the qualifications they need to have in order to get a mortgage?
Well, they need to have good credit, that's standard. They need to have between 5% of their own money. They can have 5% gifted, but they need to be able to qualify for the mortgage, and how they use that qualification is based on their income. And if their income is not reasonably stated, and there is a whole bunch of paperwork that involves reasonably stating an income, or on their line 150, which they take a 2-year average, if they haven't claimed enough, they're limiting their buying power.
All right, so what can business for self people do to maximize their buying power?
Well, it's unfortunate, and their accountant will probably disagree with them, but you got to pay the man. The government you have to pay income tax, and if you're trying to minimize the amount of income tax you're paying,
by putting in expenses?
Exactly. Basically, you're sacrificing your buying power. And when you sacrifice your buying power and you don't claim a reasonable amount on your line 150, you are stuck going to alternative lenders that are willing to state your income. And yes, the larger banks will still use a stated income, but like I said, it's getting much, much harder. So you go to these alternative lenders. So the money that you're saving in the income tax, you're spending in interest on your mortgage over the 25-year period, and also in the fees that are associated with that type of lending.
All right, Tracey, so what is a reasonable amount on their line 150 for their taxes in order to maximize their buying power?
It's really subjective, Joe. It depends on the industry that they're in and everything like that. But you have to keep in mind, if you're only going to claim $30,000, that's going to get you a mortgage of about $125 to $150. So if that's all you're claiming and that's all you're willing to pay income tax on or not pay tax on, then that's going to be what your buying power is.
That's what you can afford.
That's what you can afford. So if you increase it to $75,000, then you're up to about $250,000, $300,000 mortgage. So it really depends on what their goals are for their purchase.
All right, so what do existing homeowners need to know about refinancing their mortgage when it comes to income tax?
Most importantly, they need to know that prime lenders do not refinance any type of CRA debt. If you have CRA debt, whether it's the current year, whether it's after being reassessed and now you have CRA debt, whether it's your spouse and you're going to transfer title just into your name, no CRA debt for any type of prime lending.
even with great credit, lots of equity and job stability?
Absolutely, yep. If there is CRA debt, it doesn't matter the equity in your house, it doesn't matter whether you've been at your job for 30 years and you're salaried making $150,000 a year, a prime lender will not touch a mortgage that has a debt with CRA.
All right, so how would they go about getting refinancing if they have a CRA debt?
Well, there's a couple of options. It really depends on the certain individual and what they're willing to do. The first option would be to find alternative financing for the CRA debt. So whether it be in a second mortgage, depending on the depth of the money owing, so be a second mortgage or a personal loan. Then once you've got that settled, then refinance your mortgage into a first. Or you can go back to the alternative lending and maybe refinance for just a year, get that, because alternative lenders, there's many of them out there that will, and private lenders, that will do the CRA debt. So maybe do something for 1 year, get everything cleaned up, and then redo your mortgage back into the prime lending market after the year is finished.
All right, Tracey, so any last tips for people that may have a CRA debt or are planning on refinancing now at income tax time?
Definitely. I would say speak to a mortgage broker, speak to somebody that's going to be able to help you with the process and provide the best solutions for you. And most importantly, take care of it. Don't let it linger on, because CRA becomes very high in penalties and interest. Yes, they charge you minimal interest on the actual debt as it goes forward, but the penalties can be astronomical and sometimes overwhelming. So, speak to a professional that can help you get everything organized and start on a clean slate again.
All right, Tracey, great stuff. Thanks for coming on today's show, and I look forward to seeing you again next month.
You're welcome, Joe. Thank you for having me, as always.
So if you need any help regarding your mortgage, get in contact with Tracey Brock of Dominion Lending Centers. Thanks for watching, and we'll see you next time.